All right, folks, so it's been a little over a year since we've started using the term Fed rug pull. And we started using that term because the Fed decided to raise interest rates at the fastest pace in history. It was effectively a rug pull of the U.S. economy. Now, despite all the fake numbers and data, and we're going to cover some of that here today, we have to understand what is at play here for the United States economy, for Main Street, and for your business and your investments. So in this video, I'm going to run through it real quick. We're going to decode the economic data and lies and myths that they continue to perpetuate. Meanwhile, everyone is overlooking the most recent announcement from the Federal Reserve, which just continues to acknowledge our thesis that the Federal Reserve rug pull is underway. It's not just Main Street. We're going to show you now that they're rug pulling the U.S. banks as well. So before we get into it, I just want to say, guys, thank you for all the support. Everything can be found on my website, ZachRector.com. And without further ado, let's get right into decoding the data. So we're starting off here. The U.S. economy expands at a strong 3.3% rate in fourth quarter GDP shows, and the recession fears recede. Now, I don't know who they're asking. I don't know who they're calling up, but the recession fears definitely are not receding over here. You have to understand that last quarter, the third quarter, we did a 4.9% clip for GDP. Now, this quarter, for Q4, they had forecast 2%, and we beat it. We came in at 3.3%, but it is still less than what we did in the third quarter. Now, we're still a long ways away from the negative GDP, and remember, 2 quarters in a row of negative GDP would be your recession technical definition, Economics 101. Now, what happened in 2022 is it was politically incorrect and it was going to offend people to call it a recession. So when we did get 2 quarters in a row of negative GDP, we decided that that didn't count. Okay. And it made us all feel warm and fuzzy inside, right? Well, I'll tell you what doesn't make me feel warm and fuzzy inside is when I understand that the GDP growth can in large part be contributed to the higher cost of the same goods and services that we are producing. So we're not producing more, we're just charging more for what little we are producing. That is how you can explain it in simple terms, in one sentence. That explains why our GDP is quote unquote up or growing. Now, what everyone's missing and overlooking here is that no one else noticed in the Q4 GDP report that the annualized interest on the federal debt now exceeds $1 trillion and is projected to breach $3 trillion annualized rate by Q4 2030. Now, last night I did a live show and it was titled Realistic XRP Timeline. Now, we talked about, realistic XRP price predictions and expectations and timelines, and it took us out to 2030. I said we're beginning a commodity super cycle, and I include crypto commodities with real utility and value in that, like XRP, and that the wave up that we see in 2024 or 2025 is just going to be the start. It's just going to be that next wave before we continue on up into 28, 29, and then 30. Now, we compare that to the interest that the U.S. government is going to have to pay on its debt, and you can see the realistic expectations of annualized interest. We're now over $1 trillion per year. And you have to remember that the interest on our debt now exceeds our military budget. So this is that inflection point where the U.S. empire starts to realize, oh, wait, we can't afford to continue the military expansion and excursions throughout the planet. And what folks don't understand is that this is going to hit at home as far as our entitlement spending, everything else that we're trying to do, all the different programs, forgive this debt, forgive that debt, give a handout here, fund that war there, and the party's coming to an end. And while they say that the recession fears are receding, I don't know why or who they're talking to or what they're smoking, because pass me some of that stuff. I want to hallucinate too. Because when we look at the real data, initial jobless claims went up once again. U.S. initial jobless claims up 25,000 to 214,000 in the latest week. Now, remember that the initial jobless claim of the week prior was 187, but it did get revised up to 189. So it was even worse. And remember, they continue to do this. They put out the initial number and then they revise it. And which way does it usually trend? Which way is it usually corrected? Worse. And that was the case here too. And so now we're getting initial jobless claims of 214,000, beating the expectations of 200,000. And so I don't know why or who they are talking to that is saying that the recession fears are receding, because that is another data point in the negative. You want another one? Well, here you go. U.S. durable good orders flat in December. Economists had forecast a 1.5% rise in order for durable goods, products made to last at least 3 years. Do we even make stuff that lasts 3 years anymore? I'm trying to figure out what they're talking about, because I don't know anything that lasts 3 years anymore. Even if it's built to last 3 years, the technology, updates in the meantime. So, let's redefine durable goods, I guess. And core capital good orders, which exclude volatile sectors like transportation and defense, rose by 0.3% after a rise of 1% in November. So you can see here that the orders are not coming in. And this points to the data point last week that we got, that manufacturing survey that was the worst print that we've got since the great financial crisis. As I was saying, who are they talking to? Where are they getting that the recession fears are receding? It's an absolute joke. Now, let's get another data point here. Now, this one on U.S. home sales. The sales of new homes surged in December as mortgage rates dipped below 7%. Oh boy. Who here is bullish on housing? Let me know in the comments down below if you're bullish on U.S. housing. New residential sales rose, led by a boost in the Northeast. And let me tell you what was the real driver. It was prices coming down. It was builders dropping price, offering incentives, rate buydowns. That is why the new home sales volume surged, because prices went down. Let's be very clear. Once again, you don't have to read the stars to be able to decode the economic data. You just have to apply some common sense and look in just a little bit past the headlines. And what you see is, as I was just in Phoenix metro area, and I'm driving around in the Toll Brothers, at the top of their sign it says, special financing available. Of course there is. Of course there is. Because they're doing everything that they can to move these homes. And I get it. And please remember that new home sales are just one segment of, the overall real estate market, of course. But it is a leading indicator of where the rest of the market is heading. Because the builders don't have, they don't have mortgage rate locked in at 3%. They don't have golden handcuffs. They got short-term financing that they have to, work with and finish their product and move it before their financing expires. And so they have to get a deal done. They're not like, a regular homeowner. And you have to understand, in my opinion, for Americans, their home is their most precious, quote unquote, asset. And they are the most emotional about this asset. Whereas when they buy a stock, it goes up, it goes down. They get maybe a little bit emotional about it, sure. But relatively speaking, they don't care. It's not a symbol of them. It's not a reflection of them or an image of them. It's such a big deal here in the U.S. to have that white picket fence American dream. And this is why U.S. homeowners are the most emotional about this investment, about this asset. And for many, it's not even an investment. They call it an asset, even though it's actually a liability. And so we see data points like this. Sales of new homes surged in December as mortgage rates dipped below 7%. Sure. Okay. But like I said, when you read between the lines, it's very clear to see what's driving this, and it's incentives and it's home builders dropping price. They have room to work. They still have some margin. So they're dropping price and they're moving these things and getting them going. Okay. But once again, you look a little bit deeper, the devil's in the details. Nearly 60% of parents are now providing financial support through rent, mortgage insurance, and car payments to their adult children. So we're going to mom and daddy, not just for rent, but also for mortgage insurance and car payments, phone payments, buy now, pay later. Hey, mom, hey, dad, I did buy now, pay later for some crap, and now I can't pay it back. Can you cover me? And a lot of millennials my age actually are using their parents and grandparents to for their down payment assistance as well. And so we put all this together. Why did I title this Fed Reserve Rug Pull Confirmed? Because now it's come out from the Federal Reserve here yesterday that they are terminating the BTFP, Bank Term Funding Program, which is another liquidity backstop for the banks that was introduced last year. We had been speculating that they might find a reason or an excuse or a financial bomb would go off that would give them reasoning to extend the BTFP. But as of yesterday, the Federal Reserve came out and said that they are no longer going to continue that program. There are no more loans going to be coming out, and the program is going to come to an end as scheduled on March 11th, here in just a few, about a month and a half. And so, like I said, I started using the term Federal Reserve rug pull of the U.S. economy last year after we saw them continue to raise rates at the fastest pace in history. That confirmed the rug pull. The rug pull is being confirmed even further now at the banking level. This is going to be felt all the way down. You talk about trickle down economics. You talk about some ripple effects. It's going to be a financial tsunami of debt and liquidity that's going to be hitting the U.S. economy here over the rest of this year. And like I said, the Federal Reserve is not coming in to save the day until the bomb goes off, until there is max pain and blood in the streets. They are not your friend. Despite how much we're begging Daddy Pal to ease up on us, he's not going to, because as we've highlighted, inflation is ticking back up. And this is the predicament that the U.S. economy is in right now, where most households right now are feeling the pain. And this is why I try to decode the data so that we don't fall for these myths and illusions. Some might call them delusions of the data and the state of the U.S. economy. When we understand this data, when we understand the macroeconomic picture, then we can form a proper investment thesis. Now, I'm not here to tell you what to do, and I talk a lot about how I've positioned myself, but let me know in the comments down below what you are going to be doing to be able to ride out the storm this year. Number one for me is going to be income, and I encourage all of you guys to figure out how to bring more in. Number one, whether it's at your job, trying to get a raise, take on more responsibility, get a promotion, or whether you got your job and now you want to start your side hustle. We got to do something, folks, to bring in more cash. Inflation's not going away, and as the data shows us, it's getting tighter out there, and it's only going to get worse before it gets better. And by the time the Fed does come in to save the day, we are going to be bleeding out in the streets. So let's make sure that we survive, and we might actually be able to thrive if we actually apply our knowledge, the education that we're sharing here every single day, and we bring it into our daily lives as far as growing our businesses and making investments that are going to help us take advantage of the greatest transfer of wealth in world history. That is my goal. That is my mission. And like I've been saying as of late, set your intentions, control your energy, and bring order to the chaos around us. If you appreciate our updates, please make sure that you like these videos. Please share them out far and wide. Help your family and friends wake up. At least at the bare minimum, you'll be able to say, I tried to tell you so. I tried to warn you. I tried to help you out. You were watching Kardashians while I was trying to send you Zach Rector's videos, decoding the data and providing us education on our business, our investments, and how to get on the right side of this transfer of wealth. I appreciate you all. Everything's at my website, ZachRector.com, and I will see you guys in the next one. God bless.